Hi everyone, today we will go through how a small business owner can replicate Warren Buffett's principles within their own company. So first we need to look at some ideas on what Warren Buffett thinks differently compared to most other investors so that we can replicate that recipe for ourselves. Number one is volatility. So while most investors think volatility is something bad, Warren Buffett actually embraces volatility and thinks that is something that is good for him, that's something that he can take advantage of. So this concept of that volatility is something risky was introduced by William Sharpe and John Littner, two economists in the 60s. So they basically had the idea that the more volatile a stock is, the riskier it is. But actually Warren Buffett, he thinks the opposite. So while most investors have adopted this way of thinking, Warren Buffett has actually thought the opposite for his entire investment career. And to understand why, we need to go back to a concept that Warren Buffett's teacher, Ben Graham, was teaching. That is the concept of Mr. Market. Imagine that you own a farm, and every day your manodepressive neighbor comes knocking on your door and wants to sell you his farm. Some days he is overexcited and really wants to have a high price. He is asking for a much higher price than the farm is worth. And other days he feels depressed and low, and he offers you the farm for a much lower price, a price that's actually lower than what it's worth. And every day you can decide if you want to buy or if you want to pass. So this is the concept of the stock market, because the Mr. Market is actually the stock market, the prices of stocks. And while most investors are really glued to the screen watching the prices if they go up or down 1% each day, Warren Buffett, he's more concerned about how the actual businesses he is owning, how they are doing. So, and the wise investor will buy when prices are low and then hold on to them and sell them when prices are really high. So can you see here how Warren Buffett actually uses volatility for his own benefit? Because when the stock market is down, when prices are low, he's buying, and when stock market is really high, he is selling. Another concept that Warren Buffett preaches is that a stock is a part of a business. Most people see it as just a piece of paper or something that goes up and down in value. But Warren Buffett, he really thinks of the actual business and is not so concerned with the market and what the stock market is doing. He's really concerned with what is this business doing, how much money is it producing, what are the sales, what are the free cash flows of this company. And he's really detached from the actual stock market and really just focuses on the businesses, how they're doing, and if there is a dip in the price, if he can buy those businesses for an attractive price, then he wants to go in. So another concept is one that you're probably familiar with, the concept of diversification, which most investors have adopted as the normal way of operating. But Warren Buffett and Charlie Munger, they say that diversification, it's actually for the know-nothing investor. It's insurance towards ignorance. They say that if you're able to value a business and make good decisions, it's much more logical to make focused investments. And why is this so? Well, Warren Buffett, he says that during a lifetime of investing, you only have maybe a handful of really good opportunities that will be handed to you. And when they do, you really want to take full advantage of them. He says that the success of Berkshire Hathaway, his investment company, really comes down to a handful of different good investment decisions that he has made over the years. So one example of that is when he and Charlie, they went to look at this chocolate company, See's Candy, and Warren Buffett thought it was a little bit too pricey for his taste, but Charlie Munger, he really saw the potential in this company, so he convinced Warren that they should buy it. And that company, they acquired the entire company, privately held company, and that company has since then produced over $2 billion in dividends for Berkshire Hathaway that they then have used to buy other companies when they bought Coca-Cola, for example. So that came from a focused bet on a smart move, like a focused bet on a company they could understand, they could see the potential in doing, and that was an attractive price. So while the conventional investor thinks of, I have these 100 different stocks to diversify, to not be fully in any one of them. Warren Buffett, he thinks more like a small business owner. Maybe in your city you have some entrepreneur there who owns 2, 3, 4 different companies and has that as their portfolio. And the focused investor is doing the same. He sees it more like owning a collection of businesses that produces cash for him and that will be around for a really long time. Another concept adopted by most investors is that of efficient market theory. The idea that the stock market is accurately priced all the time. And that it's not possible to find a good deal anywhere. This is something that Warren Buffett disagrees with, because he thinks that the stock market is accurately valued at most times, but occasionally not. And that is a huge difference, because if one would say that the efficient market theory is true, Berkshire Hathaway wouldn't have been able to exist. And people would not have been able to replicate Warren Buffett's success like many people have. Because Warren thinks that occasionally the market is way overpriced. It's euphoric, like we see now with AI stocks, for example. And at other times when there's a panic in the market, for example, or in one sector, prices could be way below what the companies are actually worth. And it's during those times when people are fleeing from an investment or they're neglecting it that Warren Buffett wants to go in and buy companies, because then prices are lower and then he can find good businesses for good prices. So for the private investor or the small business owner, they could absolutely adopt these concepts for themselves and really think of, if they own their own business, what kind of business would they want to add on to that? Or if they want to create a portfolio to really get an understanding of different companies and see which one of these would I like to add to my own portfolio, when could I do that so that I have get it for an attractive price, and create their own portfolio and their own collection of companies like this. Thank you so much for watching. See you next week.